Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at MOBIX Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath this audio track. Because today, we are jumping into something, frankly, incredibly fascinating.
Yeah, it really is a unique setup.
Right. We're looking at this fundamentally fascinating small-cap semiconductor company. And they are making serious, quantifiable waves in the defense and aerospace sectors. But they're flying almost completely under the radar of mainstream financial media.
Which is exactly where you want to be looking for mispriced opportunities. They are quietly embedding their technology into some of the most advanced hardware on the planet right now.
Exactly. So our mission today is to figure out exactly how they're operating, what the broader market is mispricing, and of course what the strategic implications are for your portfolio. But to even understand MOBIX Labs, you have to first understand their basic structure.
Right, because they aren't your traditional manufacturer. They operate under a fabless semiconductor model.
Fabless. Which, for those of you already managing tech allocations, you probably know exactly what this means. But the easiest way to visualize a fabless operation, think of them purely as the architects of a skyscraper.
That's a great analogy.
Yeah, they draw up the incredibly complex proprietary blueprints, but they contract out a highly specialized construction crew to actually pour the concrete. So they design the microchips and the hardware, and then they outsource the physical fabrication to third-party foundries.
And from a wealth-building context, the capital allocation advantage of that model, it just cannot be overstated.
Because foundries are expensive.
Insanely expensive. Building and maintaining a state-of-the-art semiconductor foundry right now can easily cost upwards of $10 to $20 billion.
Wow.
Yeah, and that's not even mentioning the ongoing overhead. You have to maintain multi-billion-dollar clean rooms. You have to secure highly specialized raw materials. It's a logistical nightmare. But by remaining strictly fabless, they bypass that massive capital expenditure entirely.
So it keeps their operating overhead exceptionally lean.
Exactly. Instead of pouring billions into manufacturing equipment that, let's face it, depreciates rapidly, they channel all of their capital directly into intellectual property and elite engineering talent.
And that talent is highly, highly focused. We're talking about advanced wireless and wired connectivity, radio frequency or RF technology, mmWave 5G, switching components, and EMI filtering.
And that last one, the EMI filtering, is specifically where the fundamental investment thesis starts to really crystallize.
Right, because EMI, which stands for electromagnetic interference filtering, is basically the invisible backbone of modern high-reliability infrastructure.
It really is.
Think about the sheer density of a modern military jet or, a luxury private aircraft. You have thousands of distinct electronic signals bouncing around inside a highly confined metal chassis. You've got flight navigation, encrypted satellite comms, active radar, internal passenger Wi-Fi.
Electronic warfare countermeasures.
Exactly.
Yeah.
And without elite EMI filtering, those signals just bleed into one another. You absolutely cannot have a targeted communication array suddenly causing a micro glitch in a fly-by-wire navigation system.
That would be catastrophic.
Right. So MOBIX Labs designs the precise filters that isolate those signals, ensuring complete data integrity in these zero-fail environments.
And when you pair that specific capability with their mmWave 5G and RF components, you start to see exactly where they fit into the macro trends. These are the high-frequency bands absolutely required for massive data transfer.
Because the amount of data being moved now is just staggering.
Exactly. We are currently watching a massive global shift toward AI-enabled wireless infrastructure and autonomous defense networks. The sheer volume of telemetry and data being moved across these networks requires components that can process incredibly high speeds without a single drop in signal fidelity. They've positioned themselves exactly at the intersection of aerospace modernization and next-generation wireless data transfer.
But, okay, here is where the story gets a little complicated. And frankly, this is where a lot of institutional risk models might start flashing red warning signs.
The scale of the operation.
Exactly. We've established that they are engineering this highly complex, mission-critical hardware. Yet, when you actually look at their corporate footprint, MOBIX Labs is operating with exactly 46 employees total.
46 people.
You're looking at a 46-person team that is actively serving more than 15 distinct Fortune 500 customers. Now, I have to play devil's advocate here for you guys listening. From a portfolio management perspective, relying on 46 people to service 15 global corporate giants sounds like a massive operational bottleneck.
It sounds incredibly fragile on paper.
Right. What happens if, say, 3 of their lead RF engineers get poached by a legacy defense contractor? The key man risk just seems exceptionally high.
And that is a completely valid risk to highlight. Any thorough due diligence requires questioning that exact bottleneck. However, you have to look how a highly specialized fabless model actually scales. And more importantly, you have to look at who those 46 people actually are.
They aren't just entry-level coders.
Far from it. The executive and engineering leadership team alone holds over 100 years of combined high-level industry experience. These are seasoned veterans drawn directly from the upper echelons of the semiconductor and defense sectors.
So they already know everyone.
Exactly. They already have deep-rooted relationships with the procurement officers. They understand the exact microscopic tolerances the prime contractors require. Furthermore, in these highly specialized fabless firms, the compensation structures are typically heavily weighted toward equity and performance milestones.
Which aggressively mitigates that poaching risk you mentioned. You aren't going to jump ship to a legacy contractor for a slight bump in base salary when your equity in a booming startup is about to vest.
Precisely. But the real metric, the one that completely counters the bottleneck argument, is their customer success rating. They currently maintain a 98% customer success rate across those 15 Fortune 500 accounts.
A 98% success rate in aviation and defense hardware is just staggering. I mean, we aren't talking about consumer software here where a developer can just push a patch over the cloud if a bug is discovered post-launch.
Right, you can't just reboot a fighter jet mid-flight.
Exactly. In aviation hardware, a failed component grounds an aircraft. It triggers a massive federal investigation, and it permanently damages the supplier's reputation.
Yeah.
So operating at a 98% reliability threshold in that specific environment, that is exactly what builds their economic moat.
And that moat is further reinforced by the extreme regulatory barriers inherent to the sector. The switching costs in defense and aerospace are arguably the highest of any industry on Earth.
It's not a plug-and-play situation.
Not at all. You don't just design a superior RF chip and seamlessly swap it into a fighter jet's avionics bay. The testing, the environmental certification, the security auditing is a brutal multi-year process.
But once you're in,
Once a component is finally certified and integrated into an aircraft's design architecture, it becomes virtually immovable.
because the prime contractors have zero incentive to initiate a multi-year, multi-million-dollar recertification process just to save a fraction of a percent on a competitor's component.
Exactly. Once you are successfully engineered into the chassis, your revenue stream is effectively locked in for the entire life cycle of that aircraft platform.
Which brings us directly to the massive catalyst, the event that just completely shifted the fundamental outlook of this stock. On March 5th, 2026, the news officially crossed the wires. MOBIX LABS secured new production purchase orders for components specifically utilized in Gulfstream aircraft.
And for context, we are talking about the absolute pinnacle of private high-performance aviation.
The implications of penetrating the Gulfstream supply chain simply cannot be overstated. Gulfstream operates under some of the most stringent safety, performance, and environmental standards in the entire global aviation market. Securing a direct production order from them isn't just a short-term revenue injection.
No, it's a permanent, highly visible validation of their technology to the rest of the aerospace industry. It immediately de-risks their technology profile for other major aviation players.
Like a stamp of approval.
Exactly. When a competitor or a massive defense contractor sees that Gulfstream has fully vetted and integrated these components, the barrier to entry for future contracts drops significantly. And the market understood this immediately.
Oh, absolutely. If you look at the technical price action on March 5th and continuing right through March 6th, the trading volume completely decoupled from its historical averages. The technicals were explosive.
They really were.
And the critical data point for you as an investor listening to this, it isn't just that the volume spiked, but exactly when that volume was hitting the tape. We saw massive, sustained surges in the pre-market and after-hour sessions.
Which is the ultimate tell for institutional flow.
Right. Retail volume is generally concentrated between the opening and closing bells. When you see extreme volume spikes outside of normal trading hours, and it's paired with a massive fundamental news catalyst, you are watching institutional footprints.
That is hedge funds, mutual funds, large algorithmic desks aggressively accumulating block shares before the broader retail market can even price in the Gulfstream news.
And that institutional accumulation sparked a severe order-driven breakout, pushing the stock significantly higher. I mean, it was threatening to break through resistance levels toward new 52-week highs.
But there was a fascinating divergence during this run-up, one that really highlights a major flaw in how modern financial data is aggregated. During the height of this massive volume and price expansion, several broad algorithmic sentiment screeners were actually flagging the stock as neutral.
I saw that exact divergence. And it perfectly illustrates why you cannot blindly rely on automated dashboards without actually understanding the underlying mechanics.
Algorithms are fundamentally rigid.
Right. A quantitative screener sees extreme volatility. Wild price swings, massive volume deviations, expanded bid-ask spreads, and its internal logic immediately flags that as elevated risk. So it spits out a neutral or even bearish output.
Because it lacks the contextual awareness to understand why the volatility is happening in the first place.
Exactly. Human analysis looks at the exact same chart, pairs it with a March 5th Gulfstream headlines, and recognizes that the volatility is driven by overwhelmingly bullish, tangible revenue realization. The computer just sees chaos. The informed investor sees a small-cap company successfully locking in a Fortune 500 aviation contract.
It is the classic disconnect between quantitative risk models and fundamental value creation. However, if we're going to rely on human analysis to look under the hood here, we have to look at the entire engine.
Including the parts that are currently failing.
Exactly. We need to pivot to the financials and the valuation and present the unvarnished bear case. Because when you pull up the trailing return metrics for this company, they look fundamentally broken at first glance.
Broken is putting it mildly. Let's look at the reality check. The return on assets, the ROA, is currently sitting at negative 57.43%. And the return on equity, the ROE, is printing at an astronomical negative 3,627.68%.
Those are tough numbers to look at.
If you're running a traditional value screen and you see a negative 3,000% ROE, your immediate instinct is to close the terminal and walk away. And when you pair those catastrophic return metrics with the high volatility and unusual volume we just discussed, you have a very real, very present danger for any short-term swing trader.
It's a high beta environment.
Right. If you time your entry poorly in a high beta stock with negative returns, the price swings can absolutely decimate your position.
The metrics are intimidating, no doubt, but they require a deep understanding of small-cap accounting mechanics to accurately interpret. A negative 3,600% ROE does not mean the company is losing 3,600 times its value overnight.
No, mathematically, this extreme percentage occurs when a company has a fundamentally tiny or even negative equity base on its balance sheet.
Which is usually due to years of accumulated deficits from heavy early-stage research and development. You divide that tiny equity base by its current net loss, and you get this wildly distorted percentage. Yes, they are burning cash, but the critical question for an investor is, what is that cash being burned on?
It's not being incinerated on bloated corporate expenses or luxury retreats.
Exactly. It is being aggressively deployed to build out highly specialized, patentable IP for the defense and aerospace sectors. They are intentionally sacrificing short-term profitability to capture market share in an industry characterized by insurmountable barriers to entry.
They were essentially playing a long-term land grab in the aerospace supply chain. And that intentional short-term sacrifice brings us right to the bull case, which is entirely anchored by their current valuation. Despite the massive market opportunity and the recent Gulfstream orders, MOBIX Labs is currently trading at a price-to-sales ratio of just 0.84x.
Which is an extreme anomaly.
It really is. Let's put that into perspective for a second. If you look across the broader semiconductor and specialized software sectors right now, companies are routinely trading at 10x, 20x, or even 30x their forward sales. Finding a tech company, especially one actively servicing 15 Fortune 500 clients, trading at a price-to-sales multiple of less than 1, it's almost unheard of.
An anomaly that signals severe undervaluation relative to their tangible growth potential. The broader market has heavily priced in the current net losses and those terrifying return metrics, but it has completely failed to price in the scalable margins inherent to their fabulous model.
Because their overhead is strictly contained.
Right. Incremental revenue falls directly to the bottom line much faster than a traditional manufacturer. Furthermore, their capital strategy is perfectly aligned with aggressive growth. They do not pay dividends. They are not executing defensive stock buybacks to prop up the share price.
No, every single dollar of revenue is relentlessly reinvested back into the firm to scale their defense manufacturing capabilities and accelerate their RF and mmWave development.
And this is where the Gulfstream catalyst fundamentally changes the math. Those purchase orders are the exact direct revenue injection required to begin reversing those negative return metrics.
Once that high-margin aerospace revenue begins flowing onto the income statement and stabilizing the balance sheet, that 0.84x price-to-sales multiple is going to look painfully obvious in hindsight. The turnaround path is right there in the open.
Which naturally leads us to the wealth-building horizon and how to actively strategize around this equity. Looking at the immediate 3-month pipeline, there's a major structural catalyst developing that the market hasn't fully digested yet.
The new facility.
Yes. MOBIX Labs is currently in the process of transitioning their operations into a significantly larger military-approved facility. They are executing this move specifically to dramatically scale up their EMI filtering and defense production capabilities.
And that facility transition is a massive forward indicator. You do not absorb the immense logistical cost and regulatory burden of moving into a military-certified facility unless you have a high-conviction visibility into a pipeline of significantly larger government and defense contracts.
It tells us they view the Gulfstream orders not as a peak achievement, but as a baseline for a much broader expansion into prime defense contracting.
But for you as an investor looking at the immediate timeline, the ultimate, undeniable validation of this entire thesis will be their Q1 2026 earnings report. That specific print is the moment of truth.
It really is.
It will strip away all the speculation and show us exactly how much top-line revenue the Gulfstream orders generated and how efficiently their fabulous model converted that revenue into gross margin.
And beyond the Q1 earnings, you have to factor in the massive macroeconomic tailwinds currently lifting the entire sector. We are in the early innings of a multi-year aerospace spending upcycle. This is being driven by aging commercial fleets requiring modernization and, of course, escalating global defense budgets.
While simultaneously, we are witnessing a massive sector rotation by institutional capital. Smart money is actively rotating out of saturated consumer technology and repositioning into AI-enabled wireless infrastructure, advanced connectivity, and high-tech defense hardware.
MOBIX Labs is sitting squarely at the nexus of all those macro trends.
So let's distill all of this data into a final investment thesis. When we weigh the highly specialized technology, the impenetrable regulatory moat, the Gulfstream revenue catalyst, the severe 0.84x undervaluation, and the powerful macro tailwinds, and we weigh all of that against the very real risks of their current negative return metrics and short-term volatility, the stock earns a definitive bullish score of 7 out of 10.
The fundamental validation provided by the Gulfstream orders significantly outweighs the backward-looking profitability gaps on the balance sheet.
From a tactical standpoint, this presents a highly compelling dual-horizon opportunity. For the active trader, it is highly viable as a 3 to 6 month swing trade. You are essentially riding the technical momentum of the Gulfstream news and the institutional volume straight into the fundamental anticipation of that Q1 earnings report.
But for the long-term capital allocator, the structural dynamics offer incredible multi-year hold potential.
Because of the extreme switching costs we discussed earlier.
Exactly, and their strategic expansion into military-approved facilities. You are looking at an asset that could organically compound its value over the next several years as those 15 Fortune 500 customers inevitably increase their order volumes and deepen their reliance on the technology.
Let's lock in the elevator pitch summary so you have the entire framework clear in your mind. You're evaluating a hyper-specialized semiconductor firm focused on RF and EMI technology. They operate a lean 46-person team that is successfully servicing over 15 Fortune 500 giants. They just secured a massive fundamental revenue catalyst in the form of Gulfstream production orders, yet the market is still pricing them at an ultra-low 0.84x price-to-sales ratio.
You absolutely must manage your risk around the early-stage volatility and the deeply negative historical return metrics. But the forward-looking turnaround path, driven by scalable fabless margins and a booming aerospace cycle, is incredibly clear.
Right. It's a calculated play, but the upside is heavily supported by the fundamentals.
And I want to leave you with one final, broader strategic question to consider, entirely separate from their current balance sheet. We have spent this entire discussion analyzing MOBIX Labs as an independent, growing entity, but consider the reality of the defense sector.
The consolidation.
Exactly. You have a massive, multi-billion-dollar prime contractor looking at a tiny 46-person company that holds the proprietary IP for the exact EMI filtering and mmWave technology required for the next generation of autonomous flight and electronic warfare. If MOBIX Labs continues to secure these mission-critical components across the aviation industry, why would a defense giant simply compete with them or even continue to pay them as a supplier?
That's a great point.
In a sector defined by aggressive consolidation, doesn't a company with this specific, hard-to-replicate intellectual property and a sub-1 price-to-sales ratio eventually become an irresistible, outright acquisition target for a legacy aerospace prime looking to hoard their technology?
That is exactly the kind of strategic next-level angle you need to be exploring, and it completely shifts how you view their long-term ceiling. Thank you so much for joining us for today's analysis. We hope this breakdown gives you a definitive edge in navigating the small-cap semiconductor space. Keep aggressively analyzing the data, keep challenging the obvious algorithmic narratives, and most importantly, keep building your wealth knowledge. We'll see you next time.